the Woodford campaign, we have really four, I think, objectives. The first one was just to create a forum, an opportunity for investors in Woodford who are affected by what's gone on to be able to communicate with each other and to speak with a single voice. But in terms of substantive objectives, we are looking where possible to achieve some compensation for victims, and that's complex because there are different investment vehicles here, and not all of them have claims that are easy to follow. We're looking to ensure that those who have damaged the interests of individual savers are held to account for that action. And finally, we're looking at the way the regulation has or hasn't worked in this case, and what needs to happen, both at the regulation level, but also at the regulator level, to ensure that we don't see a repeat of this. You've had my introduction. There's the agenda. Robin is going to, well, I've explained what these guys are going to speak to. Whilst sitting looking at this slide, I'm going to propose a poll. The first poll that we have, and it's slightly out of sync because I haven't told you how to work the machine yet, but I'm sure you can manage to find a box with a mouse and click it, asks you which Woodford fund you held. Whether it is Woodford Equity Income Fund, which is the subject of this legal claim, Income Focus Fund, which is its, I suppose, sister fund, Woodford Patient Capital Trust, which is the investment trust, arguably the correct vehicle for illiquid, long-dated investments to be held in, or whether you came through the Hargreaves Lansdowne multi-manager funds that in turn were invested in Woodford Equity. So if you wouldn't mind, please letting us know. I will reveal the results of the polls. I don't think it's very fair to ask you for data and then not allow you to have the benefit of that data. So Pavlina, if we give another 10 seconds or so, and then look at the results of that poll, please. Good. Well, 92% are in the Woodford Equity, which is, I suppose, what one would expect. But there's also spectators, I think, from the other vehicles, and one or two who were in neither, which is interesting. They're obviously needing to get out of the heat this afternoon. Great. If we can move on, please. The way to ask questions during this session, please, is to use the Q&A button at the bottom. There is a chat function, but the chat function has been disabled for today. So we want to see any questions that you've got coming through the Q&A. And before you write a question, if you wouldn't mind double checking whether or not somebody has already asked the same question or something very similar. And if they have, if you would uptick it using the thumbs up button, to let me know the number of people who are asking a similar question. And what that will do is promote it to ensure that that question gets addressed. We will try, first of all, there's a Q&A session at the end of the presentations, and we will try to get through as many of these questions as possible. Where we can't, and historically we haven't always been able to get to everything, we'll try and send responses in the follow-up email that goes out. I think that's broadly it in terms of the hows and whys, and so I'm going to stop talking and allow you to listen to Robin Powell, who's going to give us his unique insight on the Woodford case. And before we do that, I'm just going to run a second poll and ask you what percentage of your personal assets were invested in WEIF at the point where it closed. Okay, and I think we can probably call that already. So in a lot of cases, 30% of net worth seems to be in the fund. So it's quite significant, quite a significant chunk of people's net worth that's here, which just underlines the seriousness of the issue. Robin, you have the show.
Well, thank you very much indeed, Mark. I, as Mark has said, I'm a journalist, an author, and editor of the investing blog, The Evidence-Based Investor. I started the blog at around the time that the Woodford Equity Income Fund was launched. I was critical at the time of, or skeptical, certainly very skeptical at the time of active management generally. It shows how far actually we've come over the years, that actually in those days it was a completely different environment. There were very, very few of us. Mark was one of them. I was another. There's a guy on the Wall Street Journal called Jason Zweig who wrote about it regularly, and just one or two others, literally, about active management, paying for traditional active management not being a very good idea. And we frankly felt like voices in the wilderness. I remember being quite critical of the Woodford launch at the time and all the publicity around it. I was critical as well of my fellow journalists who were jumping up and down with excitement about it, which I thought was very, very irresponsible at the time. I got a lot of flack and criticism from senior journalists, from Mark Dampier, had a lot of lampooning, got on the sort of wrong end of a lot of lampooning on social media. I suspected that things would go wrong with Woodford. I had no special insight whatsoever that they would do, and a lot of people now contact me and say, look, I was so grateful that you saved me from getting involved in that mess. It wasn't any sort of foresight or genius on my part. I was really just trying to explain to people the odds of actually beating the market through Neil Woodford. I didn't expect things to go as spectacularly wrong as they did, I'll be quite honest. And as Mark said, one of the big questions is, why did they go so wrong? And at this point, we could possibly go to the slides, please. I think there are three main theories about, or sort of two really main theories about what went wrong. And I'm going to suggest a third theory of my own, which I think actually is really, really worth considering. And the first one is that he strayed beyond his expertise. And this is probably the one that we hear the most. Warren Buffett has always made a big thing about staying within your circle of competence. He told Berkshire Hathaway shareholders in his 1996 letter, you don't have to be an expert on every company or even many to be a fund manager. You only have to be able to evaluate companies within your circle of competence. And I think it's fair to talk in terms of Woodford Mark I and Woodford Mark II. Largely Woodford Mark I at Invesco, perpetual, although I'd suggest that we started to see signs of Mark II as well at Invesco. He was a contrarian. He took bold bets on unloved companies. He liked large, dull, dependable, income-generating stocks. He wasn't afraid either to back controversial businesses, obviously, famously including tobacco companies at a time when others were steering clear of them. And then there's Woodford Mark II, which is a completely different animal. He started actually investing in small private companies around 2010. This is something that's not really talked about very much, but possibly it should be. In a sense, the writing was already on the wall at Invesco that this is what he wanted to do. He felt frustrated that his bosses were, if you like, cramping his style. There's a suggestion actually that he didn't leave, he didn't quit Invesco, but that he was pushed. We don't know the truth on that, but it's an interesting theory. So he set up this flagship fund called the Equity Income Fund, but of course it didn't resemble an equity income at all. It was really more like a private equity fund. And over time, of course, there came these big withdrawals, which forced him to sell the FTSE 100 stocks, you know, the Woodford Mark 1 stocks, if you like. He had to sell those to shore up the liquidity, and that left him with a rump of largely unlisted stocks and, frankly, moonshot bets. So, yeah, I think there's a very, very strong case for saying that Neil Woodford forgot what he was good at and strayed beyond his area of competence. The second one, he began to believe his own genius. And again, I think there is much to be said for this. The bottom line is that beating the market is very, very hard. Only a very small fraction of fund managers actually get to do it. And in the books that have been written about the Woodford crisis, there are interesting stories about this kind of, if you like, growing narcissism in Neil Woodford. He ordered a glass office to be built at Invesco so he could shut himself off from the rest of the business, for example. He reveled in the media attention surrounding the launch of Woodford funds. There was even a story in the Financial Times that he had a phone adjusted, attached to a specially adjusted saddle on his horse. He's obviously a very keen horseman, so that he could actually make trading instructions while riding his horses through the Cotswolds. And I don't know if you going back to Buffett again, if you compare that with the Buffett approach, you know, here's someone at 90, nearly 92, who spends 5 to 6 hours a day working, voraciously hard, poring over books, newspapers, company reports, and so on. You know, the idea that Woodford had that he could, if you like, be a successful fund manager, but still go riding in the Cotswolds and driving fast cars around Tetbury and so on at the same time as literally making his trading instructions, really just showed how he kind of lost the plot, if you like. The third theory I just want to talk about is this idea that he wasn't actually a brilliant stock picker anyway. He made 2 hugely successful calls. He avoided the dot-com crash at the end of the last century. He sold banks famously also long before the global financial crisis struck. And compounding is an amazing thing. And when you actually factor in the compounding on those 2 decisions, just 2 life-changing, career-changing, industry-changing decisions, if you like, those made a huge difference. And actually, if you take out the compounding success of those 2 decisions, his performance would have actually been quite unremarkable. I had the pleasure of interviewing a guy called Ian Tonks, professor of finance at Bristol University, a few days ago. You may not be familiar with a study that he's written with various others, including David Blake, New Evidence on Mutual Fund Performance. It basically shows around 1% of fund managers show genuine skill over the long term on a cost and risk adjusted basis. 1%. And get this, that even those 1% recoup for themselves any actual value, in inverted commas, they add in fees and charges. The other thing they pointed out, that it takes 8 years of performance data of a fund manager outperforming, if you like, for a test of a fund manager's skill to have 50% power, and 22 years of data for the test have 90% power. So, distinguishing luck from skill in fund managers is extremely, extremely difficult. I would suggest that Neil Woodford, frankly, just reverted to the mean. Yes, he got too big for his own boots. Yes, he strayed beyond his area of expertise, but he basically reverted to the mean. let's have a very quick look at recent developments. I wish I could tell you more. Unfortunately, things move very, very slowly in the Woodford justice world. Remaining assets are unlikely to be sold, next slide, until 2023 or later. Now, the plan was for everything to be wrapped up by the end of this year. That is not now going to happen, I think we can safely say. Carl Middle from the Authorised Corporate Director Link said in March, due to the nature of the fund's remaining assets and our commitment to achieving the best outcome for investors, it's possible the wind up of the fund may not be completed by the end of 2022. I think we can safely say that it won't be. He added he was unable to provide us specific dates for further payouts for investors. Another big development, we've seen a new chair appointed at the FCA. His name's Ashley Alder. He comes from the Securities and Futures Commission in Hong Kong, where he's been since 2011. But he doesn't take up the role until January anyway. Nikhil Rathi, the authority's chief executive, said in a letter to the Treasury Select Committee at the end of last year that all key evidence has been gathered in the FCA inquiry, but that the watchdog needed more time to study the information. Yeah, clearly here we are 7 months later, and apparently it still needs more time. Mel Stride, the chair of the Select Committee, has urged the FCA to move quickly, but frankly, there is no real escaping the conclusion that the FCA would really rather this subject just went away, or that it became such a distant memory that we didn't care as much about it as we currently do. The third development to tell you about very briefly is that a comeback for Neil Woodford is looking increasingly unlikely. It was announced last week that a new firm called WCM Partners has applied to be struck off Britain's register of companies according to its filings. And so it's unlikely that we'll see Neil Woodford at least return to a job in UK fund management, though he continues to be connected with posts abroad. And I get posts from the United States, for example, who are very worried about Neil Woodford going over there and doing damage over there. So that's going to be very interesting to see. Very finally, a question that interests me is only around 10% of claimants have joined claims against Link. Personally, I would have liked to have seen Hargreaves Lansdowne brought to book, and I think that applies to a lot of investors too. And if Hargreaves had been on the hook, if you like, they probably would have joined, but they haven't for that reason. That notwithstanding, I am very surprised that so few have signed up. I'm not a lawyer, but there does appear to be a very, very strong case against Link. I've carried out a couple of polls lately, one on Twitter, and I basically said, why is it? Where are the missing 90%, if you like? And the top reason by far is they're not aware that they can sue. In second place was they don't expect to win, so they'd be kind of wasting their time anyway. And a long way behind in third and fourth, don't believe in suing. And it's a sort of British thing, isn't it, that we maybe don't like to revert to legal action, and also possibly that investors don't need the money, but that's only a very, very minor factor. I did a similar poll on LinkedIn, and that produced very, very similar findings. The final thing, guys, that I would say, thanks for showing the slides. I just wonder as well whether there's an element of people wanting to piggyback here off claimants. They want to see how it goes. They don't want to pay any fees. They don't want to commit themselves. I'm sure Meriel from Lide will explain the sort of statute of limitations implications and so on. But one or two people have told me that that may well be an issue as well. That's all I've got to say.
That's fantastic, Robin. Yes, I think Meriel is going to talk a little bit about timeframes. I think there may be a degree of complacency in people. Certainly from your polls, not knowing that there is a case going on and not knowing that they have a claim, but also perhaps thinking that there isn't a time frame associated with it. And with only sub 10% of the potential claimants having registered at this stage, I think it's becoming very urgent that we get that information or that knowledge out there. I was looking today at Money Saving Experts website, and there's very little on Woodford on there. And what there is there's a sort of mini forum. And what there is on there is very ill-informed, and it's clear that for interestingly, the trend on there was to question, why would you expect to get your money back when you've made an investment and lost? That's part of investing. And I don't think the message has perhaps been got across that people didn't do what they were supposed to do in the managing of your money. And if you lose money because somebody makes a bet and that bet goes against them within the parameters of the mandate, that's one thing. But we're dealing with something rather different here, at least potentially. So before we move to Meriel, I was going to ask you to fill in the poll, but you've done that. So 75% of those who are on today have registered with Lide misspelt, and 20% haven't signed up yet. So that's sensible, and we're expecting a combination of people who are signed, for whom these webinars are updates to let you know what is happening, but also people who are thinking about signing up to a claim to find out why they should be. So that's a sensible proportion. Meriel, I'm going to hand straight over to you. Thanks very much, Robin.
Thanks very much, Mark, and thank you very much for having me on the webinar today. I am a solicitor in the team at Lide, working on the case that we are bringing on behalf of investors in the Woodford Equity Income Fund. Lide currently represents approximately 13,000 individuals, and we are the largest single group of claimants bringing claims in connection with the fund. We're really proud to be representing the thousands of investors who've lost out through no fault of their own, as I think Mark was saying, and we're working hard to secure justice. In the next 10 minutes or so, I'm going to tell you a bit about the claim that we're bringing, give an update on the progress we've made to date, and talk about the important work that remains to do. Next slide, please. So for anybody who isn't already familiar with us, Lide is a Times Top 100 law firm. We're highly regarded in the legal directories and ranked tier 1 in many of the areas that we specialize in. We're a leading firm in group actions and have extensive experience of complex claims against large corporations. And I've put the details of the main team working on the case on the slide. So you've got Richard Meeran, who is head of international and group litigation at Lide, who leads the team and sets the overall strategic direction for the litigation, who's supported by India and myself. Next slide, please. We're also working with an excellent counsel team. We've got Derek Dale QC, who is a leading silk at Fountain Court Chambers, and Teniola Onabanjo, who is our junior working with us, and she's at 3 Verulam Buildings. Both of these counsel have extensive experience of complex commercial claims, financial services disputes, and we're really lucky to be working with them on this claim. Next slide, please. Next, I'm going to tell you a bit about the group action that Lide is bringing. So we're bringing an action on behalf of people who invested directly in the Woodford Equity Income Fund, not any of the other funds and not the multi-managed funds. The claim is against the company that was the authorised corporate director of the fund, and that's a company called Link Fund Solutions Limited. And this is the company that was legally responsible for ensuring that the fund was managed in accordance with the rules that apply to this kind of fund and the prospectus in place. So although Woodford was the name of the name on the fund, and he was the kind of character behind it, it was Link Fund Solutions that was legally responsible and who actually appointed Woodford as the fund manager. So they sort of remain on the hook for what happened. And the claim that we're bringing is that Link mismanaged the fund, it broke the rules that apply to funds of this kind, and that caused investors loss, in that it caused the poor performance, the suspension and winding up. So we're claiming for our clients compensation to put investors in the position they would have been in if the fund had been properly managed. And it will be the subject of expert evidence, and it will be hard fought in the litigation what that looks like. But as a sort of indication of what that might be, say for instance you invested £10,000 in the fund, and through the winding up and distributions, hypothetically say that you've received £6,000 back. So you've made a capital loss of £4,000, but there's also the profit that you reasonably expected to make when you invested in this fund. And Woodford regularly compared the fund's performance with the FTSE All-Share Index. So that's a kind of benchmark with what he was aiming to achieve. And what we will be arguing is that investors should be put in the position that they would have been if they had not only not lost that capital that they invested, but also made a profit. Next slide, please. A lot of work has been done to date to get us to the stage that we're at. So we've had a detailed investigation into the claims. We've worked with barristers and experts to develop the arguments on behalf of the claimants. And we've had extensive pre-action correspondence with the defendant. But the key things that I wanted to highlight is where we've got to so far. So we're now at the stage of having issued claims at court for a large cohort of our clients, and we're continuing to issue more claims on a rolling basis. And we've applied to the court jointly with another claimant law firm, Harkers Parker, for something called a group litigation order. So to explain a bit about what a group litigation order is, this is a procedure, a mechanism that the courts have where there are a large number of claims which give rise to common or related issues of fact or law, the court has the power under the court's procedural rules to make something called a group litigation order. And this will set out, one of the things it will do is set out what are the common issues which need to be established for the benefit of all the claimants, and what are the individual issues that need to be established on an individual basis. So in this case, it is for the benefit of all the claimants that we established that Link was in breach of the rules that apply to this kind of fund in the way it managed the fund, and that resulted in losses in the value of the fund. Next slide, please. So as part of this application for a group litigation order, we've also filed at court something called the generic particulars of claim. We filed this in draft, and there will be a later stage in the proceedings when the final version is filed. And this document sets out the common facts and allegations made on behalf of the claimants. It's quite a long and detailed document, so I don't propose to go into all of the detail, and many of you will be painfully aware of what happened with the fund, and we've also had that very helpful presentation from Robin. But what I did just want to draw out for you is the key thread of the legal argument that we're making. So I've put on the slide the fund's investment objective set out in the prospectus, which was that the fund promised that it would try to provide a reasonable level of income together with capital growth, and that this would be achieved primarily by investing in UK listed companies. And when you look at the reality of what actually happened with this fund, there is an obvious contrast between that statement of intention in the prospectus and what actually happened. Over time, the fund was increasingly invested in small, startup, early stage companies whose success or failure, it's difficult to predict with confidence, companies which are less likely to pay dividends in the foreseeable future and therefore are not income generating. And as a result of investing increasingly in those kind of companies, the fund became increasingly illiquid, concentrated in speculative and hard to value stocks. So that leads to the 3 key allegations that we set out in the document: that there was an inappropriate overall investment strategy, there were inappropriate levels of investments in risky, illiquid, speculative and hard to value stocks. And that led to an increasing risk that the assets within the fund were being overvalued because they are difficult to value assets. Next slide, please. Oh, I think one back on the slide, sorry. Oh, no. And one forward, I'm getting muddled. I think we've lost one of the slides. Has it gone in the wrong order? There should be one titled "The Application for," there we go, perfect, sorry about that. In the application for a group litigation order, we're asking the court to order a number of things. And I've put a couple of those on the slide to give you a bit of an idea of what we're asking the court to do. And a couple of ones to highlight are, we're asking the court to appoint Lee Day and Harkers Parker as the joint lead solicitors. And what that means is that we will have primary conduct of the litigation going forwards. We will prepare generic statements of case like the document that I've just outlined, and we make arguments on behalf of all of the claimants, and then any individual issues will be dealt with separately by the individual lawyers instructed. It would also set a deadline for signing up to the claim, and what we've asked is that the court sets a deadline of 6 months from when the order is made. So it depends when we get to a hearing and then when the court makes an order, but that's what we're asking for. And then it would also enable cost sharing between the claimants. So it would enable, or we would ask the court to make an order which deals with cost sharing, and that would enable, we hope, a fair division of the liability for costs among all claimants, regardless of what firm they have instructed. Next slide, please. And this should be the one that says, what does it mean? Perfect. So as I'm conscious that in the press, there's been a lot of coverage about Lee Day and Harkers Parker have merged, and that was kind of on the information in advance of this webinar. What this means is Lee Day and Harkers Parker are working together on the common issues like I've explained, but each of the firms continues to represent our clients separately, and individuals still choose one law firm to instruct them and agree to that law firm's terms and conditions when they do so. So if you instruct Lee Day, then you provide your documents about your investment to us. We will then issue your claim at court for you. You would have the benefit of the insurance policy that Lee Day's taken out, which I'll explain in a moment. You would have any correspondence with us, and if you have any questions about your claim, you would come to us and we would write to you with updates. But we would do things like instructing barristers to make legal arguments for all of the claimants together with Harkers Parker. And crucially, this means that the terms on which you instruct lawyers are the terms you agree with the individual firm you instruct, and the fees are the fees that you agree with that firm. So anyone who's already instructed Lee Day, your terms will remain the same, and anyone who's considering which firm to instruct, it's really important to read and understand the terms that you're signing up to before you instruct lawyers. And that takes me on to my next slide. A bit about Lee Day's terms, and I apologize for all the people who already signed up. You will, I'm sure, be aware of this already, but the costs of litigation on this scale are unfortunately quite expensive. There's the costs of lawyers, barristers, experts, insurance, and in order to give the case and the claimants the best prospects of success, we have to properly invest in and resource the litigation. And the way we do this is we have a commercial litigation funder who pays all of the upfront costs that we have to incur as the claim goes on in order to, do the work that we need to do and instruct experts and all of that. So they pay the upfront cost of our disbursements and some of the legal fees, and then some of the legal fees are deferred and only paid in the event the claim is successful. And there's also a success fee if the claim is successful. And the funder also is only repaid its investment if the claim is successful, and in that event they would also get a return on their investment. So the fact that we've got a commercial litigation funder to put their funding behind this claim is a strong demonstration of confidence in the claim that we are bringing. But crucially for investors, it also means that we're able to offer to act on a no-win, no-fee basis. So the amount that Liday's clients will have to pay in the event that the claim is successful is covered by a deduction from any compensation you receive, and that deduction is capped at 30% of any compensation awarded to you and that you receive, and that's inclusive of VAT. And then if the claim is unsuccessful, the claimants don't have to pay anything. The costs are covered by the funder and the lawyer's discounted rates, and the rest is not paid. The other important thing to highlight about the claim that Liday is bringing is that because we've got this litigation funding, we've been able to pay to take out an insurance policy which protects our clients in the event that the claim is unsuccessful. So normally in English litigation, the general rule is loser pays, winners cost. So if the claim is unsuccessful, the claimants will be in a situation of having to pay linked costs for successfully defending the claim. But this insurance policy that we have will cover that risk. So if that happens, the claimants don't have to pay anything. And that's a summary of our terms, and it's more detail is set out in our detailed conditional fee agreement, which is available on our website, and I'll put that on one of the slides at the end. Next slide, please. And this is, I've talked for quite long enough, so I'm just going to try and really quickly talk a little bit about what there is still to come in the litigation and give a bit of an indicative possible timeline. But it's important to stress that every litigation is different. This all depends a lot on what the court orders in terms of setting deadlines and what the parties do in terms of responding to those deadlines and what they try to do as the litigation goes. But mainly, the next steps are likely to be, we have a hearing for this application that we've made, and that will set in place some structure, some deadlines, which the court will set. So we're hopeful that that could be listed from October 2022, given the court holidays, but we're still waiting to hear from the court when that will be. And then once we have those deadlines in place, we go through what we call pleadings. So the claimants set out their claim, the defendant Link has a chance to set out its defense in a separate document, and then there's a chance to reply. And also alongside this, and probably we've asked for 6 months from when the order is, there will be a deadline for signing up with the claims that are being managed as part of the group litigation order, and the court will set that deadline as part of its group litigation order. And based on the fact that we're hopeful to get a hearing in October, maybe a bit later, and then we're asking for 6 months, we think first half of 2023 is a sort of likely timeline for when that might be. And then following that, we will have probably some more case management from the court. And then the main steps in the litigation will be disclosure, which is a key stage in litigation when we try and get documents from the other side which set out or which sort of evidence the allegations that we're making. So we hope that there will be really useful information there. And then we will exchange witness evidence, expert reports. And after all of that, if Link doesn't come to the table and try to settle before any of those stages, there will be then a trial. And realistically, looking at the amount of work there is to do and the stages and the time needed between each stage, a trial is unlikely to take place before 2024. But we are obviously doing everything we can to move it forward as quickly as possible, and also to put Link under pressure so that they do come to the table sooner. Next slide, please. Last slide. So yeah, this is the details for the website where you can sign up to the claim that Liday is bringing or find out a bit more. But also, and I'll answer any questions that anyone's got as much as we have time today. But if you've got any questions that you'd rather ask us directly, please do send us an email, and the email address is on the slide. Thank you very much.
Fantastic. That's very clear. Thank you very much, Meriel. I think it underlines the fact that we've still got 90% of people who have not joined a claim, and the fact that there is a deadline, even though the deadline is a year away. People not need to start thinking about that. One question from me at this stage is there an onus on the other claims to join the group litigation, or may they go forward alone? Generally,
the court does like to see claimants sort of coordinating with each other, and I think it is something that we will have to talk to when we get to a hearing. We have been in touch with the other firms to try and, you know, we've shared with them our draft documents before we filed them, and we've updated them on our process, and we have indicated to them that as soon as they're in a position to contribute to the costs of the litigation and contribute to the work, then we would welcome having them on board with our approach.
Fantastic, thank you. I'm sure there will be a lot more for you. I see 60 questions in Q&A, so we're going to have our work cut out. Thank you very much indeed. Next speaker is Baroness Altmann. Baroness, you have been introduced, so I'm not going to do it again. I'm going to hand the floor straight to you, if I may.
Thank you, Mark, and good afternoon, everybody. Very interesting session, and this does touch on issues that I feel are really important for all retail investors in the UK and for the confidence in our markets and fund managers. So the topic for today is the fallout from Woodford and lessons to be learned. So I'll go through some of this, if I may. The highlights for me are the regulatory actions were too little, too late. You had funds with rising risks, falling liquidity, and daily prices. And yet investors were told these were low risk funds. They were assured by the rules surrounding this type of investment that there were limits on the amounts of illiquid assets that could be held. But clearly the fund managers found ways around this. So the second issue is that there were clear warning signs in 2017, like the Guernsey listing for the illiquid holdings, which was an obvious red flag. What was going on? And it seems to me that we have a regulatory system that is ever so adept at bolting the stable door long after the horse has escaped, when actually what the consumers need is proactive prevention. And I'll come back to that. And allied to that, I think a really important question is, does the FCA itself have adequate powers to look after consumers in the way they should expect to be looked after, and certainly the way they are led to believe they will be looked after when investing in reputable companies covered by regulatory rules and authorizations in this country? It's not like some fly-by-night offshore tax haven without many transparencies. So what does this mean for confidence? And I mean, the background is pretty interesting, because the funds were set up in 2014, and this was a star fund manager who had invested successfully and outperformed successfully for 20 years. And he clearly would have been tempted to try and make more money for himself and his own bottom line rather than Invesco, the company he was working for. And it was understandable, I guess, that he wanted to break out on his own. And indeed, for the first 2 and a bit years, he was a top performer. Let's not forget that. So, you know, there are reasons why there were a lot of people putting a lot of money into his funds, and why the regulators may have been relaxed, and anyone recommending his fund seems to have been quite relaxed. And again, he had been through periods of poor performance in 1999 and then recovered really well. And again in 2009, before the crash, the financial crisis, he had underperformed and then suddenly outperformed. So the idea that, you know, after 2016, when he had a period of underperformance, there was something that would never recover, I think was an understandable skepticism. And you know, many people remained loyal to him. And you could argue that his type of fund management should be looked at over the long term, rather than, if he has a bad year or two, everybody exits the fund. However, he was operating in a market where there were controls and there were restrictions. So if we're asking ourselves, whose fault is this? I'd just like to go through quickly the various actors here and see what one might say about them. So first of all, Woodford himself. Well, clearly he had confidence in the positions that he held, but he over-relied on large illiquid positions. And during his underperformance, some of his biggest clients wanted to redeem, and he ended up having to sell the most marketable stocks and hold on to those that he believed would give the best long-term value and were, if you like, untradeable. What he then did in 2017 to bundle the illiquids up and pretend they were liquid was utterly unacceptable. And yet somehow he personally has managed to get into the position where he might have set up a new series of funds before the investigations have even finished. Then there's Link, of course. Well, they were responsible for ensuring adequate liquidity levels, and they clearly failed to do that. And I would argue that there is a big question mark over whether, as Neil Woodford himself has said, suspension and closure could have been avoided, perhaps by offering investors an opportunity to move their funds into this patient investment trust and hold on to them. And I would also like to know how much money those buyers of the illiquid investments, some of which clearly made huge profits in the end, how much they gained at the expense of the Woodford customers, where Link Solutions was selling these holdings and not necessarily paying or allowing the investors in the company or in the failed fund to have any profit share in future profits, for example, which might have been a way it could have been set up. Then we come to Hargreaves Lansdown. Well, I am baffled, I must admit, about keeping Woodford on the best buy list, even when the investors, other investors and the industry may have spotted warning red flags, such as the 2017 changes. Many investors will rely on companies like Hargreaves Lansdown and their recommended lists to do some due diligence and make sure that they are recommending companies that they've analyzed in depth, because we're talking here about mostly investors who are not professional investors, who are paying money to fund managers to do the expert fund management that they themselves can't do. And there is this huge asymmetry of information between what the ordinary investor can understand and what a company like Hargreaves Lansdown, with its huge research department and its claims that it can identify really good funds for you, would understand. And of course, the fund managers themselves who know even more about the details. And 76% of the customers in a survey who had put money into the Woodford fund that failed had done so through Hargreaves, only 5% through a proper financial advisor. So these are clearly lay investors. They're not sophisticated. And one needs to ask what the business model was for companies like Hargreaves getting paid by Woodford. And indeed, they were asking questions as late as 2019, admittedly, but still had the fund on their list. So I think there are big questions to ask here. And, you know, the comparison with LCF and the administration in 2019 is worth investigating. And then finally, the FCA. Well, it doesn't seem to have any checks or controls on the best buy lists of these organizations that claim to give what is effectively guidance, although many people think it's advice. And it's the Wild West. The consumers are trusting that these companies are doing due diligence and research, and that the regulator has authorized them and they can be trusted. And yet that clearly hasn't worked. The FCA has been looking into this after 2019, as I say, stable doors and horses, but it hasn't even included Link in the review, apparently because there's an ongoing investigation on Woodford. But it has clearly found weaknesses in governance, in operational controls, and in conflicts of interest. And I think that's a big one with the ACDs and the AFMs, where they seem to have considered the funds that they were in charge of to be operated actually by investment managers or those who were looking at the funds rather, or steering the funds, rather than they themselves, who are actually the ones that are supposed to be responsible. So what the FCA is saying here is that it missed the warning signs. It is now finally looking at why maybe it missed those warning signs, what went wrong. And I think even as the risks were rising, the regulator seems to have ignored the impact on ordinary investors who were trusting that the authorization of authorized corporate directors and authorized fund managers actually meant something, that those companies couldn't just break the rules that were already set and have no regulatory comeback. So, you know, I think there are issues here. The FCA says now, in fact, it's just released its 2021-22 annual report today. And what it says is, last year we worked more effectively to protect consumers. Well, surely that's what they were supposed to be doing all along. And they are adopting this new approach to be more innovative, adaptive, and assertive, and to use data better to prevent harm sooner. Again, that doesn't fill me with huge confidence. And they've also said we're going to try to be more proactive to protect consumers within, admittedly, their limited powers. But quite honestly, for a properly proactive approach, we're going to have legislative change to fix the gaps in legislation, because the FCA does not have enough power to impose things like punitive penalties on a timely basis. It's still looking at who did what when and what went wrong why, 3 years after the fund has failed. It doesn't have the power to, for example, reduce management fees during the suspension of a fund. So everyone who was managing the fund was still getting paid nicely, even while ordinary investors had their money in a fund that was suspended and had their money reduced again and again to pay fees on an ongoing basis. So, you know, I think clearly for my money, there is inadequate protection for members. The authorization of ACDs and AFMs needs to actually mean something with proper checks, regular checks. And, you know, if ordinary members of the public are happy, and they had been, to pay expert fund managers to select a diversified range of assets, which can mitigate stock-specific risk for them and apply knowledge, which, you know, I do believe that active managers can outperform. And it is not impossible to imagine that in a truly long-term thing like an investment trust, a different holding, that the investments that Woodford made could have come good. I can't say that for sure, but certainly in the past, he has delivered really stunning outperformance. And the idea that, oh, because he avoided the banks or avoided dot-com stocks before the two previous crashes, 1999 and 2009, somehow that wasn't a mark of skill. Actually, that is something that active management did add good value to, and the passive funds would have just been caught out by the falls thereafter. So lessons learned, I would say, the FCA needs to be more proactive. What about random checks? What about making sure that there are provisions to uncover wrongdoing before everybody else finds out about it and before more and more people lose money, which is what was happening with the Woodford situation. Until it collapsed, lots of people knew that there was a problem and that there was a liquidity issue, but somehow nobody did enough about it, that they could be doing mystery shopping. The risk controls that are there for a reason need to be enforced. You know, it shouldn't be optional that if you're selling a fund to the public, which is badged as low risk and offering diversified range of assets, liquid assets, including large marketable securities, as well as a portion of longer term illiquid, potentially illiquid holdings, the limits in place must be strictly adhered to. And you can't just go around trying to list companies. I mean, I'm sure they thought it was a very clever idea, but if the regulator knew about it, and if they didn't, they should have done, and there should be proper reporting requirements to make sure the regulator is informed when something like that happens, then we need to have better enforcement, and that there should be clear responsibility so that there's not a doubt about who is responsible and who needs to be held to account, so that the legal cases, for example, if things go wrong, don't quite know whether the fund manager had responsibility directly, whether the ACDs did or did not do what they should have done, and whether there are in place some kind of official regulatory protections that, if the regulator does not do what it is supposed to do and is not protecting consumers, there should be some compensation mechanism, perhaps, for that too. I asked that question. I think it's a really important one. The regulator often sees its remit as protecting competition and protecting the market. And of course, the regulator is funded by the fund managers and the companies, not by customers directly anyway, although of course they'll pay somewhat towards that in fees. So let's have better protection for the ordinary investor. Let's have a mechanism whereby the required changes in legislation or regulations, if they are recommended, have a mechanism to be enforced, or if the regulator itself can tighten up its processes quickly. And for goodness sake, let's have a resolution to this without having to wait years and years, when people who've got money that was part of their pension are living on far less than they should, because there's been a regulatory failure and there's nothing they can do. So I sympathize with everyone who's lost money here. I think it is a shameful episode in our, what generally speaking is a pretty good fund management industry. And I think we do need to learn lessons, and we also need, importantly, to understand the difference between guidance, whereby members of the public think somebody is recommending something to them, and actual advice where someone will take responsibility for the recommendations And I believe we need an end to the kind of conflicts of interest that, you know, paying people to recommend your funds, or rewarding them in some way to recommend your funds, is currently permitted, because clearly that has the potential to drive most unsuitable behaviour.
Baroness, thank you very much. That is extremely clear. I would add a couple more red flags. I think that unless I missed it, there was the 70 million shared transfer to Woodford Patient Capital in exchange for Woodford Patient Capital shares, which should have been another red flag for. And I absolutely take your point. But the difference between unsophisticated investors and those who are making recommendations, for those who are making recommendations, that should have been a clear red flag, and for regulators, it should have been a clear red flag. And the other thing that was going on was a reissuance of shares that were pre-IPO, because there was a limit to the amount of time that the fund could hold them. And by collapsing a share class and reissuing a share class, they were playing fast and loose with the timelines there. So there were lots of red.
There were so many potential red flags, and it is really sad to sit here now, years after the fact, and recount them. Yep. and realise that actually nothing was done. You know,
well, I think in summary, the issue was in any system there needs to be checks and balances, and there were checks and balances here, and they failed. And the major part of that checks and balances was Link, that just didn't seem to understand that was its role.
Yeah, and that's what the FCA is looking at. That's what it has now said. It has suddenly discovered that these firms don't understand their responsibilities, or are operating as if they don't have the responsibilities that they do have. But you would think that authorization would require that to be clear before anybody's authorized.
Absolutely. Thank you, Baroness, very much indeed. I hope you're going to stay with us for Q&A. We have 112 questions waiting for us. But thank you very much. And I'm now going to, if I may, pass the baton to Cliff at Waite to talk about the 4 legal claims. Cliff, yours.
Good afternoon, and thank you, everyone. The next slide, please. Well, the 4 claims, they don't actually target Neil Woodford himself, nor Woodford Investment Management. And the reason for this is because you're not able to get litigation finance for such claims. Why? Well, it's expensive to sue. It takes a long time for these cases to go through court, millions, and it's only worth suing someone if they have deep pockets. And Woodford Investment Management doesn't have deep pockets. It paid all its money out in dividends and remuneration to staff. And trying to prosecute Neil Woodford himself would be a particularly difficult case to prove in law. And as the Baroness has just said, it's taken the FCA 3 years for them to consider this point, and they're still not yet to opine on the issue. What are the cases we've actually got current? They're Link and Hargreaves. Link is a very much better case. It has the best probability of success and deep pockets, or at least we think they do. Now, many people, and I've been looking at some of the Q&As coming in, are saying that Hargreaves Lansdown did wrong. And many investors want to be able to claim against Hargreaves Lansdown, who they feel misled them. However, we must remember that Hargreaves provide an execution-only service. The vast majority of these people were under those terms and conditions, and Hargreaves will argue they are not giving advice and were not. It is arguable, as we've heard before, that Hargreaves encouraged their clients to buy the Woodford funds. Our data shows the Hargreaves clients are much more likely to hold Woodford funds compared to clients of other platforms such as AJ Bell or Interactive Investor. Interactive and AJ Bell, they did not promote Woodford, and they didn't promote it the same way that Hargreaves did. Hargreaves cut a cute marketing deal with Woodford, and they fed Woodford with seed capital of £1 billion. And Hargreaves' marketing materials stress the lowest fee rates available would be by investing via Hargreaves. And of course, the Woodford funds featured towards the top of the Hargreaves Wealth and Best Buy lists. The council's opinions that I've seen, and I've seen 3 of them, are clear that the Hargreaves case is not such a good one, and certainly nowhere near as good as the case against Link. If it had to go to court, it would be more like a 2-month case rather than a 2-week case. It would be very expensive, and it would be difficult to get litigation finance for a claim against Hargreaves. The no-win, no-fee promise requires both litigation finance and after-the-event insurance to be in place. So insurance is important to give comfort to claimants, and Lee Day and Harkers Parker both have this insurance. RGL have finance only for their initial phase, but not enough finance to go to trial and complete the case. This slide shows that the claimant numbers and highlight that Lee Day is well ahead in this race. 12,000 signed up and probably about 15,000 in total, including their probables. It's twice as many as Harkers Parker. So the numbers are wrong here. Harkers Parker have announced 7,500 claimants. In terms of fees, the comparison is 30% at Lee Day compared to Harkers at 42%. RGL looks very good at 25%. And it's also very attractive to say that their claim is against Hargreaves. And we also must remember that Link have made very clear its intent to defend the claims vigorously. And this is why insurance is so important. Link have appointed Clifford Chance, who are a very expensive Magic Circle law firm, to help them defend the claim. And so, in summary, Lee Day and Harkers Parker are much further ahead, having issued court proceedings and the group litigation order, much further ahead than the other 2. Next slide, please. In November 2020, ShareSoc decided to endorse Lee Day's claim. We use 5 criteria to assess the alternative claims, and the first 4 of those points I've already covered, so I won't go into them again. But the mechanism for distribution of award is very important. And we remember the RBS shareholder action claim when the company agreed a settlement, but much of the money is yet to arrive with the claimants, and it's being subject to a battle between various lawyers and funders. ShareSoc did not want any repeat of that here, so we looked very carefully at the mechanism for distribution of any awards, and we are happy with the small print. And on that basis, we were pleased to endorse the Lee Day claim, and with the benefit of hindsight, we appear to have made a good call. Thank you. That's all I want to say to all questions.
Fantastic, Cliff. Thank you very much indeed. And I'm going to move swiftly on to questions. I'm going to ask the panelists to open up their videos. Mike, if you dare, I'm more than happy for you to remove the slide so that we can see the panelists in full size. But if you don't dare, don't worry. Well done. Thank you. First question, and I'm going to rattle through these, I'm afraid, because there are so many. Referring to previous questions, it seems quite obvious that Hargreaves Lansdowne should bear a lot of responsibility in promoting Woodford, and he was still in their wealth 50 when the funds collapsed. How does HL get taken to task and held to account for their involvement? And before asking anyone to address that, I'm just going to make the point that our target, our objective here, our primary objective is to look at individual investors who have lost money and to put them back in the situation that they should be in by returning the money that they have lost. So although there is a huge psychological pressure to identify people who may have done wrong and make sure that they're held to account, the primary focus is to reinstate the finances of shareholder of investors who've lost money through Woodford. But having said that, Meriel, I think you've sort of addressed this, but can I ask you just for a couple of words on that, a couple more words on that?
Of course, yeah. I think on the point of sort of holding Hargreaves to account, there is still the FCA's investigation ongoing. We don't know exactly what the FCA is looking into, but I really hope, and I think everyone here really hopes, that they're looking very closely at Hargreaves and the way it conducted itself. So we sort of keep our fingers crossed that something sensible comes out of that. In terms of, for the legal claims, whether there is any sort of merit in going after Hargreaves Lansdowne, obviously, as Cliff's explained and as I've touched on a bit, Leaday and Harkers Parker are both focusing only on bringing claims against Link. And we did spend a long time investigating the claims against Hargreaves Lansdowne and decided that suing only Link was the best way to go. And exactly, Mark, as you say, focusing on getting compensation for people. And a couple of things just to explain here. Again, as Cliff has said, we think that the Hargreaves Lansdowne case has additional hurdles to cross, and that's not something that we need to be doing in order to have a chance of getting compensation for claimants. But also, and really significantly, is the costs risk. So suing two defendants rather than one, who each have two separate sets of lawyers defending the claims, making different arguments and generating points that need to be responded to, would lead to increased costs. And in a situation where people are claiming their losses as a result of investing in the fund, there's a significant overlap in terms of what losses you could claim from one or other defendant. And in that situation where you can only really get compensation up to sort of 1 times what you've lost, if going with both claims against Link and Hargreaves meant that you ended up effectively losing one in favor of the other, then you're in a position of, okay, you've won some compensation, but you've also got the costs liability against the law firm, against the defendant that you weren't successful against. And that's a cost risk that we don't think is worth taking where there is a clear route against Link.
Thank you, Meriel. The situation is slightly more complex, I think, for investors via the Hargreaves multi-manager fund. And there it's not necessarily as much about what Hargreaves has done wrong, but the fact that they don't seem to be going after any kind of redress for their fund. And given what's going on parallel to them here, I think that's something they need to be watching very, very carefully. There's a couple more which are going to come your way, and then I think hopefully we'll get over.
Mark, let me just add on that, because I've been in contact with Hargreaves just recently, and they've said that. And I asked them this question about the multi-manager funds, and they said they hadn't. They're still looking at it.
Watching brief, sensible.
The watching brief. Maybe I'm reading too much into that. That means they're going to do something rather than just watch it.
I think they may have understood that if they do nothing and there is success under this claim, they're going to start looking a little unprotected.
And on the other point, I'd add that there's a lot of new executives at Hargreaves Lansdowne. There's been quite a clean out of their senior executive team, and the share price has gone down from £26 to £8. So the shareholders have certainly suffered extremely because of this.
Good, thank you. Next question is, realistically, what chance do investors have of getting some or all of their money refunded? Also, will this take, say, 5 years? And there was a written question that I received beforehand also that looked for sort of outer estimates on timeframes, optimistic and pessimistic. So it's difficult for you, I think, Meriel, but do you have a feeling for how strong, how good, how probable this is for investors to see a return and time frame?
Yeah, so I think the best indication that I can give is the fact that we've engaged with a commercial litigation funder, and they've decided to fund the claim. So they've put their investment in the fund, and they only see that money back if the claim is successful. So that is the best, I think, indication I can give. We do think it's a strong claim. In terms of the timing, the best case scenario, I think, is Link offers a really reasonable and fair settlement offer to the claimants, and that could happen at any point. So, you know, we hope that that comes soon. And then the worst case scenario, yeah, unfortunately, is that it takes quite a number of years to reach a resolution. There is, in litigation, quite a lot of strategy involved. There's things a defendant can do to obfuscate any responsibility, but we will do our best to press things forward as quickly as we can.
I'm going to suggest that Link Fund Solutions Limited doesn't have the resources to make an offer, and that a parent company is likely to hide behind the corporate veil effectively. So I think your likelihood of an optimistic outcome is quite low.
I take your point. They do have a reasonable amount of resources under management. They are part of a large group, and having this litigation holding over them is not something that they may want to do. So we remain hopeful for a settlement.
Perfect. Thank you. A slightly broader question, which I think Robin and perhaps Baroness Altmann should take, which is, why did Hargreaves Lansdown not see flaws in Woodford's strategy? Baroness, you've slightly addressed that, so can I let Robin have a go first?
Well, it's a very moot point. I mean, there've been two very good books written about the Woodford scandal. And both show that Hargreaves were given ample opportunity to see that things were going wrong, and the consensus of those authors who I've interviewed extensively is that they saw that he'd succeeded in the past. They'd, if you like, found the goose that laid the golden egg for Hargreaves Lansdown. He was bringing a lot of money in. And let's face it, Hargreaves Lansdown did fantastically well, and the few senior executives retired from Hargreaves Lansdown very much better off as a result of promoting Neil Woodford's fund. I think they just literally took their eye off the ball and assumed that everything was hunky-dory when it clearly wasn't.
And a linked question, I think, to this, has Mark Dampier ever answered the charge that he liquidated all of his Woodford assets just a day before the Woodford funds were frozen? And a third question in the series, Mark Dampier had significant responsibility for promoting Woodford and benefited financially just before the collapse. Has he been investigated?
Well, as I understand it, he hasn't. There were apparently two sales by Dampier and his wife in the run-up to the collapse. And I think the last one happened about a couple of weeks before June the 1st or 2nd, 2020, when the whole sort of house of cards collapsed, if you like. And you have to ask the question, what did he know that he wasn't telling Hargreaves Lansdown customers? As Ros says, the fund remained on the best buy list right up until the day that it was suspended. I have asked Mark this question. I've not had an answer. I noticed one of the questions posed in the Q&A was, what has happened to Mark Dampier now? Well, he's actually talking about funds again, and not exactly recommending funds. I hope he's kind of learned that lesson, but he is still effectively giving advice, if you like, whether you call it guidance, advice, help, or whatever. He's still giving guidance to investors, which it sticks in my throat a little bit.
Thank you. And Baroness, your thoughts on HL and Mark Dampier, please.
Well, I really don't want to get drawn into ad hominem remarks here. And I have to say that, for many years, Hargreaves Lansdown did serve many customers really well. Originally, it offered, good value for people who wanted to select their own investments. The problem is, I think they strayed over into capturing ordinary investors who were trusting Hargreaves to do the research, rather than people like myself, for example, who was for many years with Hargreaves, although not now, who know about shares, who understand how to analyze, that was my profession, and just want a reasonably cost-effective way of holding those chosen shares. This is a completely different case. And for me, the biggest problem, and I say this time and again in financial services, especially in the retail area, is that if you look at the issue of commission or rewards, if you like, for recommendations, it is the root of all evil. If you give skewed incentives to a company to, if you like, drive business towards yourself, and that company is perceived as being on the side of the consumer, then you set up an immediate conflict, and time and again, it has let consumers down. Trusting ordinary people who have given over their hard-earned money to the industry, and they think to experts who they believe are actually on their side, and actually regulatory wise they have no cover and no protection, and they don't understand it until it's too late. So I don't understand why Hargreaves was asking the questions and still kept this fund on its best buy list. It makes no sense to me.
Thank you very much. I got a few questions that relate to the claim through lead A and the structure. Is there any prospect of getting an award for costs, and would this affect the amount that lead A takes? Also, is the 30% the maximum, and could it be less? And the answer is yes, the costs are capped at 30%, but if you look at the waterfall, the realistic likelihood of anything getting to the bottom of that waterfall is very low. So I think the way that an investor should look at this, or a potential claimant should look at this, is that 30% of any award is going to be absorbed by the funding and the legal costs. I'm happy to be countered on that, but the second question in that series is, only a small percentage of the investments are part of the various claims ongoing, which is a point that we've made so far, that there is less than 10% of potential claimants registered. If there is success with the claims, do the other higher percentage of investors not part of the claims, not benefit from the claims, that are not part of the claims, stand to gain any of the benefits? And that I'd like Meriel to address, please. And there's another one which we've identified as answered, but I think is actually worth drawing out. It didn't get so many upticks, which is, if we join one of the claims, is there any chance at all that we could end up with a bill if the claim is not won? And I think you've spoken about insurance, you've spoken about finance, funders, and so on and so forth. But is there a route by which costs can come and bite a claimant, and you could end up with a second with a good money after bad situation?
Mm-hmm. Okay, I'll deal with the first question first. The litigation that Lead A is bringing and that the other law firms are bringing is only for the benefit of people who've signed up to the claim and are part of the litigation. So when we get to the end of the litigation, either a settlement or a judgment, if that is in favour of the claimants, that will only be for the claimants who've signed up with the litigation. And then it may be that there will be follow-on claims and other law firms start advertising, but there may not be. We can't. I can't sort of speak to that. And then the second question, sorry, Mark, I haven't got that one in front of me, was...
it's just about whether or not there's any route by which there can be a blowback of costs to
Yes.
to a claimant.
Yeah, so we've taken out an insurance policy that we considered to be adequate for the stage and that we're at, and having considered the risks, we do keep this under review as the claim progresses, and we expect this to be a case where the costs are budgeted, so the court will have some oversight of the cost being incurred by the lawyers. But it is litigation; we can't deal with every possible risk, and we've done the best that we can to ensure that claimants are robustly protected, and we do think that we've got enough, but we can't deal with every foreseeable eventuality.
And just looking just looking at the components of that, obviously, if there were a costs award against and the insurance failed, you have a theoretical potential route. But the financier presumably could never come back, and you could never come back against. So the lead aid costs and the finance costs could never blow back against a claimant.
It's so on the insurance, one thing just to flag is that we've got the insurances with an A-rated insurance provider, and if the insurer fails, then it is eligible for cover from the Financial Services Compensation Scheme. So I think it's incredibly unlikely that we'll be in a situation where the insurer fails, and then if there is, there's protections in place for that. In terms of that's the adverse cost risk, the risk that link has costs to recover from the claimants. In terms of lead aid fees and the funders' fees, those are only payable on success. And so, yeah, you're right. There's no blowback if those don't come through.
Okay, so I mean, I think one can describe this as belt and braces. Yeah, my experience of insurers failing is not usually a credit issue; it's a documentary issue. But yes, point taken. Thank you very much. Question: who is supervising the FCA to ensure they finish marking their homework on time? It's pretty awful that they're allowed to be judge and jury on this. It's worse that they're late in their report and haven't given a clear timeline on when they will release it. Baroness, possibly that's you.
I think the Baroness has had to leave us, actually, Mark.
Okay.
She waved goodbye while you were.
She did wave, did she?
But I think I can answer that the FCA really reports to the Treasury. And so the Treasury make the key appointments at the FCA, and then there is a select committee in Parliament as well where they can ask questions. And indeed, they did call Andrew Bailey when he was the chairman, chief executive of the FCA, to quiz him in detail about the FCA's role and why they hadn't enforced the 5%. Limits liquidation rules and 10% liquidation rules.
Thank you, Cliff. I have a question here. I don't quite understand the question. I have cash in Hargreaves Lansdowne following the sale of WEIF assets. Should I remove it? And if I do so, will I not then benefit from any compensation if it became due? I don't know whether that's in multi-manager funds or it's just in HL as custodian, but Meriel, would you mind?
Yeah, of course. I think I understand what you're describing. I think you're describing a situation where you've received as part of the winding up of the fund, some distributions have been made, and so that's come into your Hargreaves Lansdowne account as cash. In that case, that is absolutely your cash to do what you want with. There is no requirement for the purposes of the litigation for you to leave that sitting there. So invest it, spend it, do what you want with it.
Fantastic, thank you. That's yeah, you understood it a lot better than I did. There's a comment rather than a question, which is that Hargreaves Lansdowne is the only reason I invested by their strong recommendation, which is perhaps something that one wants to record, because I'm sure that there's a number of people who are in the same situation. What is Link's financial ability to pay out on a successful legal action? And if they're not able to pay, is it correct that there will then be redress to the Financial Services Compensation Scheme? Meriel, I think that's you again.
Yeah, so Link is part of Link in the UK is a big company. They manage lots and lots of funds as part of their authorization to fulfill their role with the FCA. They did have to prove to the FCA that they have adequate resources. We haven't been able to sort of peep under the hood of that and know what they've got in place. They may have insurance to cover claims, or they may have a willing parent company that will step in. It's part of a large international group which is profitable, and so we are hopeful that there is something there. And then in the event that we pursue this all the way to trial and we get a judgment and Link fails to pay that judgment, so Link defaults, and that would be the company going into failing on its legal obligations, then there is the Financial Services Compensation Scheme, and as part of Lead Aid's terms, we would assist our clients in applying for compensation via that scheme.
Thank you. And related question, and I think we sort of semi-addressed this so far, which is that if only 10% of investors taking action through these claims, could Link see this as a bit of see the likely payout as a bit of pill for them to swallow, but be put off settling because that might leave them vulnerable to further claims from the remaining 90% of investors, and that might prejudice a settlement. And I think probably there's a degree of statute of limitations coming into this as to whether or not others. Robin kind of mentioned this earlier on. Whether or not investors were sitting watching to see what happened with a view to following on, and I'm not sure that option is really going to be available to them. But Meriel, you're probably best placed to talk about that time frame.
Yeah, so the option of joining with the firms that are currently bringing actions is sort of the options that are already visible and available to claimants. And then whether there will be, if we go all the way to a trial or we get a settlement, whether there will be follow-on claims is something that we can't really predict. But the claims that are currently acting are very likely to be sort of ruled out from acting for any future investors, because there would be a conflict. So it would have to be another firm coming on board, and then that many years later down the line, there may be limitation issues or other reasons why they don't want to follow on. So it's difficult to predict, to say with any certainty that there won't be other options, but there's none that we can sort of guarantee will be there.
And there's no mechanism in the UK, as there is in the States, of effectively saying, of the courts saying, look, here is a settlement. I want you to make it available to the broader investor group.
Not through the litigation that we're bringing through the courts. No.
Okay.
There is a precedent of the FCA agreeing a settlement with a company who's got problems, and then making it enforced on all the shareholders. I think that Centric is a recent example.
Okay, I don't know if there's a parallel there.
Well, it is as part of the FCA's investigation. They may look into whether they think any party is liable. But if they, given the pace of their investigation, we think that the group litigation is the stronger route to follow. But if something comes out, then we would sort of consider it for our clients and advise them what we think is in their best interest to do.
Okay, thank you.
And Meriel mentioned the point about limitation. Not sure if everybody's clear about this, but a new claim might miss the 5-year or 7-year rule, and so it would run out of time if it's not careful. That's why people need to act now, or within the next 6 or 9 months or so, depending on what the GLO announcement is. Powell announced deadline for the applying for the Lee Day or Harkus Parker claims. Yeah.
So, and Meriel, the statute of limitations on this is from the point where it was known that there was a misdeed. Is how many years?
So it's 6 years from when there was a breach of the Financial Conduct Authority's rules for managing the fund. But in this case, the approach that we're taking is that was an ongoing breach. So we look at losses that continued accruing across the whole time of the fund from when things started to go wrong.
Okay, thank you. And there's a question on whether or not the redress will be subject to a standard 8% interest court rate.
As part of the claim that we're bringing, we are claiming for interest, but it's interest at the rate that the court thinks fit. So that will be sort of decided at the point that we get to a trial or a settlement.
Okay, and that of course goes down the same waterfall.
Yeah, as part of the compensation that claimants receive, interest will be wrapped up.
Thank you. I'm looking for something that I can throw at Robin or Cliff, because a lot of these are very technical. I guess the frequent one is why not Hargreaves Lansdowne, and there's a question as to whether or not if RGL joins the action with you, what that does to their potential claim against Hargreaves. And I think if I'm right, it's fair to say that all of you have effectively left open the option of going after Hargreaves, but they are two separate processes.
Yeah, so the structure and the court procedures that we're asking the court to impose through this order relate to the claims against Link only. And if RGL is continuing with the claims against Hargreaves Lansdowne, then that's for them to sort of work out how they do that and how they structure it.
Can I just ask, Meriel, is part of the issue here, Meriel, that actually you don't want to go after Hargreaves Lansdowne and you want to kind of keep them on board, if you like, because they're actually going to be important part of your case, probably a very important witness. Is that right? I mean, it's obviously understandable if that is the case.
That's not part of the reasoning of why we've not gone after them. It is the fact that the case against Link, we feel, is the stronger case, and the cost risks of going against two defendants are the main reasons why we've focused on Link.
Okay, and will individual claimants hear from you when their personal claims are presented to the court? So the questioner here registered with you at the start and provided information on the claim, but hasn't had any further information about the claim going to court. So what's the communication process?
So as soon as your claim is issued at court, you will hear from Lee Day. We will update you. And I am conscious that some people signed up to the claim a while ago and the claims haven't been issued. We're dealing with them in batches and we're getting people's claims issued as soon as we can. But I can reassure you that these claims will be moving forward sort of together as a group, and the time at which your claim is issued is not going to affect your claim, the time that you get compensation or the prospect. So it's a kind of administrative thing on our side for us to group people and get as many issued as we can.
Thank you. And an issue that we spoke about last time, the Ombudsman, there's a question that is saying, do I have to withdraw my Ombudsman claim in order to join the legal claim? And my understanding is that, yes, it's an either or. Whether or not you can reverse out of an Ombudsman claim is technical. So yeah, your thoughts on that? Yeah, exactly. So Lee Day is only offering to act for people if you haven't got another claim ongoing, either through the Ombudsman or with another law firm. And so if you have an ongoing claim, that's sort of for you to decide, ongoing claim with the Ombudsman, then decide whether you want to withdraw that and sign up with Lee Day, or wait and see what happens with your financial Ombudsman complaint. Okay, so but you can withdraw from the Ombudsman. Yeah. Excellent. We're getting down to a point where the questions are relatively similar, and I think they would benefit probably from grouping and answering in written form. And also we're now 6:13, so I'm going to ask, if I may, for each of you to just make a few words in closing, and we'll start, if I may, with Robin.
Yeah, I mean, just very, very briefly, Mark, I absolutely understand that your, and I say your ShareSocs and Lee Day's priority is very much on getting legal redress for investors. I suppose as a journalist and campaigner, financial educator, my concern is the future, and stopping this thing from happening again, because it will happen again, because nothing's been done since this. There will be more Woodfords. And I think the critical issue, sorry to go back to Hargreaves Lansdowne, is third parties effectively promoting funds and suggesting that they know in advance which the winning funds of the future are going to be. I thought Ros spoke brilliantly. The one point on which I really do disagree with her is on the value of active management. How do we know that Neil Woodford was actually skillful at all? If you ask the likes of David Blake or Ian Tonks at Bristol, can you predict the winners in advance? They will categorically say it's impossible. So why are we trying to pretend that it's still possible for, whoever it is, whether it's Hargreaves or AJ Bell Interactive or whoever, why are we still pretending that it's possible to pick the winners in advance? It's not. Fantastic. I would just bring you back to our objectives. It's not that we're blind to what's happening in the future and the
the first approach is to try and get people's money back. The second is to ensure that there is some comeback on people who have not done what they were supposed to be doing or done it badly. And thirdly, that it doesn't happen again, that there is regulatory response. So we do share. We just because we're dealing with an individual investors are an interesting psychology. They get very angry, and the focus is on that anger. And part of our role is to calm down and say, no, focus on getting your money back. That's what you personally, individually need. And I understand a journalist has a slightly different approach, but we're talking about people here who had 30%, according to our poll, of their net worth stuck in this thing. So they're yeah, there's a clear ranking in our view. Cliff, I'm going to let Meriel have last word. So over to you now.
The FOS isn't working. We met with the financial ombudsman last November, and they said they were hopeful of getting some of the claims resolved. They've a few very easy IFA claims they've resolved, but any of the claims against Link or against Hargreaves, they're sitting in the FOS, and there's no sign of them coming out of their machinery. So that's a big problem. And so we will chase them up again and again. Redress, well, we've got two jolly good claims now, which are going together, and lots of people have joined them, but 90% haven't. So we've got to get the word out there that there's another 270,000 people who need to claim. Tell your friends, tell your families, tell everybody about it, please. So retribution, there's so much anger. The questions and answers tonight, which I've been reading, there's so much anger about Hargreaves and the role of Hargreaves, and Baroness put it very, very well. There needs to be something done. Quite what? But one of the things is it's far, far too slow. It's got to be much, much quicker. They do it in the US. The US probably wouldn't have allowed Woodford to pay out a huge dividend, and if they did it, they'd have called it back. And somebody would have ended up in wearing orange pajamas with stripes down them, and it would be a plea bargaining, and it would be done much, much quicker. Regulatory reform, yes, it needs to be reformed. I'm not quite sure what it is, but either the two FCA letters they've written, and they wrote one to the fund managers saying you've got to look after your liquidity, and they wrote that was soon after after Woodford problems emerged, and then sometime later they wrote one to the ACDs telling them they've got to look after the liquidity, and they're responsible for it. Now we've got to come to decide whether those two letters are enough to make regulation work, or whether proper regulatory reform needs to happen. And lastly, point is about education. If we need to educate investors much better, and ShareSoc is very keen on doing this, and we'll be launching a new initiative shortly about financial education. It's very clear in this case, a lot of people did not diversify their investments properly and didn't understand what they were getting into.
Fantastic. Now, I was intending to have a nice closing slide, but given that we are all up, I'm going to put the poll, our final poll, up before we go to Meriel, which is, for me, of intellectual interest as to whether or not the investors in Woodford Equity Income Fund were there by their own research, or whether they were there at the suggestion of an advisor, an independent financial advisor.
And bearing in mind that Hargreaves Lansdown doesn't give financial advice, so they're not a financial advisor, even if you thought they were.
And if we can take a look at the result of that, please. Okay, 83% self-advised, and that does underline the importance of the use of research and the reliance that is placed on research on the way through that process. Fantastic. Meriel, you have last word here.
I guess I would just reflect on everything that everyone's been saying and pass on that we do at Lead Day really feel the weight on our shoulders of trying to get some compensation for investors. It's really important. It's people's life savings, it's people's pensions, and we really do want to get some compensation for you. It's what people deserve to get after this horrible ordeal. And also to echo the calls for regulatory reform. It's really important, especially at the moment in the sort of wake of Brexit that we're in. The Parliament and the FCA are looking at regulatory reform. They're looking at the financial markets. They're looking at how to protect consumers. And we really need to be calling out the ways in which they can enhance what they're already doing, or the ways in which things aren't good enough. And I know that the Financial Conduct Authority is looking at bringing in a consumer duty that will impose on financial services firms a duty to sort of be acting in the consumer's best interest. But is that really enough? Is there more that we can do? And just, yeah, exactly, echo or endorse the good work that people like Robin, Baroness Altmann are doing, and ShareSoc are doing, to call for that regulatory reform that we so much need.
Fantastic. Thank you very much indeed.